Hello, everyone. It's a US inflation day, as you might already know. A very well anticipated indicator, especially after the shock that we had on Friday with a really strong and solid US labor market once again. Surprisingly, the NFP has beat expectations. Unemployment was high. It was actually beat expectations as well on Friday. And that's why today's reading is even more crucial than what was supposed to be under other circumstances. So today, we have dedicated the session, the webinar session on inflation. So we're going to go through what is inflation and how it affects the markets, the different types of inflation, etc. So as an excuse of today's crucial reading out of the US, which is a key indicator, as you might already know, for central banks' interest rates as well, we're going to explore interest rates and inflation and how and why it creates volatility to the market. So also we're going to go through, actually, let me also share with you the parts of this live session, which is, here we go. So we're going to go through what inflation is, what affects inflation, and how it affects the Forex market. So we're going to discover today how to speculate on the movement of the most popular Forex pairs, plus what impacts their rise and fall. So before we start the session, I would like to double check with you guys whether you can hear us, you can see me, hear me loud and clear, you don't have any audio or visual issue. Also, a quick reminder that for any question that you might have, not necessarily only about today's session, it might be you're struggling with your strategy, you need some help in your trading, and you need some education, some help, okay, regarding your strategy, your trading. So let me know for any issue that you face. We're gonna try and help you via our email address, webinars@hfm.com. So feel free to let us know if you need any help. We are here to help anyway. So we are dedicated on help you with anything you need, and that's our motto, especially the analysis team motto since the beginning of HFM as a company, as a Forex broker. So let me just welcome Zoran, welcome Brian, welcome guys. So in case that you prefer, you can join me via YouTube as well. So you in YouTube, you can see the screen and the camera as well. So feel free to join us in YouTube channel as well. Like, I have some feedback in regards to the audio. That's absolutely great. And I think we are good to go with the very first slide. Why is inflation important in Forex? Okay, very good. Let's hide that as well. Perfect. So, as I said, this session is dedicated on inflation. So it's for everyone, beginners, intermediate level traders, even advanced traders, as we're gonna go through everything regarding to inflation, what it is, how it's affected, from what factors it's affected, what's the consequences of a high inflation or a low inflation, and how it affects the market as well, and more precisely the Forex market. So very good. So I would like firstly, as you can see in my slide, to take it step by step. So before we move to the actual inflation and what it is, let's go through interest rates. Why is that? Because it might be it's the key tool that the central banks are using in order to control inflation. So I would like firstly to go through what is the interest rate in order for you to understand and comprehend better the inflation as well. So what is the interest rate? So the interest rate, guys, is the overall lending rate in a country, right? So which obviously ties into the overall rate worldwide. So think about US, for example. So US interest rate is either the stipulated amount at which commercial banks in the US borrow from each other, okay, or the rate as such at which commercial banks may borrow from the central bank, which is Fed in this case. So what's important about the interest rates? The most important part of interest rates, it's the fact that it's being used by central banks, as I said earlier, in order to control the economy and to support the economy. So what I mean? The most important interest rate, which is set by the central bank, for US is the Fed, for UK is the Bank of England, for Canada is the Bank of Canada, for Europe is ECB, and so on and so forth, affect all other interest rates in the economy. Okay, so central banks, okay, of very influential economies such as US, ECB, the Europe, UK, Australia, and etc., affect affect developing countries' rates too. So whatever the major central banks do, whatever they change in their interest rate outlook, it affects all the other developing countries as well. Why is that? Because interest rates play a central role in spending, in consumption, with other words, in wages, labor market as well, imports, exports. So you understand that it affects the use of them and how central banks use them, okay, influence the entire economy as they have a trickle-down effect, as we call it. So if the rate is hiked, which means increased, that increases cost of borrowing by banks, passing to business and consumers who they pay interest rates on loans, right? Which also constrains spending. We're going to see everything in a bit with illustrations as well, so you will understand how the interest rates affect immediately the businesses, affect the consumers and their spending as well. Just very, very briefly. On the flip side, as you can see in our slides, right? Which it doesn't change easily. On the flip side, if the interest rates reduce, what that means? It means that loans become cheaper to pay back and spending increases. So with other words, people have more to spend and less to pay for their loan. So that's why I said initially this is a very, very important tool to help control inflation and stimulate economic growth during periods of stagnation. And we're going to have in a bit what stagnation is, what stagnation is, and what happens if we are in a period of stagnation. So, effects of interest rate changes into the exchange rates, right? Into our currency pairs. Just a reminder at this point that anything you need, I'm here to help. Please stick on our chat, right? At the bottom of our live, either in YouTube, LinkedIn, Twitter, Facebook, and etc. is the comment section. So feel free to add your question, anything you want to share with us, and I will be here to reply as soon as possible. The same stands for the attendees via GoToWebinar. Guys, anything you need, I'm here to help. Barak, it is in the handout section. Please feel free. Oh, you're requesting. Can you send an email to the support team, please? To the webinars@hfm.com, and the team will provide the notes for the scalping the NFP session. Okay. Thank you very much. So let's move on. Okay. So interest rates, as I mentioned earlier, affects the exchange value in the Forex market because the rates movements directly impact demand of currency. Why is that? Let's take it step by step. So let's come on. Here we are. Perfect. So why there is this correlation between interest rates and the demand for a currency? This is because interest rates are a measure of the return, okay, on certain investments and savings. So due to the relative attractiveness of interest rates, investors they may want to move capital into or out of a country. So that impacts supply and demand for a specific currency. So let me give you an example. If, for example, in Europe, the interest rate is, let's say, 1%, okay? But in the US, the interest is 3%. For an investor, okay, it's very attractive to take its money elsewhere away from Europe, and more precisely to US. Why? Because if it deposits its money in Europe, it will gain 1% interest rate of its capital. But if it converts it into the euro into dollars and moves them and deposits them in US, it will get back 3% interest rates on its deposit. So this is what impacts supply and demand for a specific currency, the carry trade, as we call it. Nicole, don't worry. I'm glad you joined us. You haven't missed a lot, okay? You haven't missed a lot. Don't worry about it. Anyway, this session is pre-recorded, so you can find it in our, once we're done, we can find it in our social media, YouTube channel. And Nicole, you will receive anyway a recording in your email as well, okay? Thank you very much. So, as I said, due to the relative attractiveness of the interest rate, investors may want to move their capital into or out of a country, and that affects the supply and demand of a specific currency. However, guys, Ibrahim, okay, yes, of course you can. Ibrahim, of course you can. Of course you can if you visit again once we're done or whatever you have free time. Our YouTube channel, it will be there. Okay, thank you very much. Okay. So as I was saying, guys, it's very important to remember that the effect of interest rate changes on Forex is never guaranteed. Okay, it also doesn't happen in isolation, but rather depends on several factors, such as the perception of an economy's future strength or stability. Remember that markets is about sentiment. If inflation today comes out and it missed expectations or beat expectations, is not it might theoretically, if inflation comes higher than expected, right? This supposed to be, let me share also the calendar with you guys. Theoretically, if inflation comes higher than expected, okay, this tends to have negative impact on the, a positive impact on the US dollar. But this reaction, this theoretical, traditional reaction is not guaranteed, because as I said earlier, everything depends on the perception from the market participants regarding the future of that specific economy. In this case, is US today. So let me share the calendar as well. Yes, don't worry, guys. This is recorded. You will, the attendees of via GoToWebinar you will receive it in your inbox, and all the rest, guys. All of you that you are in social media, the video stays in social media, so you can come back anytime that you are free and watch the video. Okay, don't worry about recording. Okay, thank you very much. So here we are. Let me share the calendar as well. Yes, okay, perfect. So in every economic calendar, if you click on the explanation of each indicator, you will see also how it is expected to affect the particular currency that is related to. So in this case, it's US inflation. So we can see that the high reading is seen as bullish for the US dollar, while a low reading is seen as bearish. But I want you to remember, guys, that that is not a guarantee. This reaction is not a guarantee. Why is that? Because as I said, market moves based on the perception of the market participants for that particular economic indicator. So the reaction will be on the sentiment, okay, regarding the US economy future, and also how it could impact the Fed decision. So as exchange rates depend on the supply and demand of a particular currency, as I already explained, all factors that impact on either of these will affect the value of the currency. So you should have this top of mind at all times when you conduct your analysis on the markets. So, for example, you need to have at the back of your head also what happened on Friday, right? And how Friday's results and today's result could change or not change the central bank's outlook. Now, you need to consider. So consider this factor during market analysis, as we said, we stated over here. So what we mean, you need to consider, once the release is out, you need to consider in general, all the factors, indicators, the latest indicators that we have, economic releases that we have from the US, and where they are pointing in regards to the future of the US economy. Okay, let's move on. Okay, so I know that we haven't touched as such what deflation is yet, but one step at a time, I want you firstly to understand interest rates, how they affect the exchange rates, and then we will move to inflation in order to understand the combination of these two concepts. So the combination of inflation with interest rates and how they affect the exchange market. So I have a picture over here explaining precisely how the price of a currency can change based on the quantity of currency traded. And so the green line is the supply, right? The red line is the demand that is changing based on the increased demand after interest rate hike. So when interest rates are increased, okay, you understand that you can achieve a better rate of return on your savings, right? You have your money in a saving account in the bank. So if the interest rates getting higher and higher, you will get a better rate of return to your investment, to your deposit, etc. The same stands for other formats of investments, such as lending or government and corporate bonds. You might, if you have invested, if you have bought or purchased government bonds, right? The higher the interest rate gets, that will mean a greater return for your investment in government bonds and so on and so forth. It's all about the better rate of returns if the interest rate increases. So in theory, money will move from currencies in economy with less desirable investment opportunities to a currency with better prospect. Like the example that I gave with Euro and US, right? So in theory, money move from currency to currency, from currencies in economies to from currencies in economies in general, with so it will see a cash out or a move out from less desirable investments to an economy, to a currency with better prospects. Something that positively impacts its exchange rate, exactly with the example that we gave earlier in regards to the euro and Europe and US. So the flow of money will drive demand, as we said, higher for the preferable currency, while the currency experiencing less demand, that one will depreciate, because if a lot of investors are going away from Europe, for example, because it has 1% interest rates, and they move their money to US because it gives 3% interest rates, you understand that that it will mean less demand for euro and higher demand for dollar. So with this way, we'll see that the demand in Europe will depreciate, and the demand of US, the preferable currency, will move higher. This is what this picture presents. Okay, it presents this negative effect, this opposite effect that we can see in the exchange rate. So P and P1 show, okay, the change, the increased demand, okay, the increased demand in currency appreciation. Okay, here we have the original demand for currency, which increased, as you can see, after we had an interest rate hike. So the higher the interest rate, right, the higher the demand for the currency, the preferred currency. So the higher the currency appreciation, and you can see that the supply of the currency rises as well. Okay, So let's move on to see what happens when we have a decrease in the interest rates. What happens to the Forex industry, to the demand for Forex actually, when interest rate decreases? You with me so far? Mario, I cannot help you right now because this is a live session. I cannot help you right now regarding past webinars. I can see you're asking something about entry exit strategies. Can you? It will be helpful if you send us an email at webinars@hfm.com. Okay, requesting for these videos, and the team will be more than glad to help you and will provide you the videos, handouts, whatever you need for those sessions. But right now, because I'm live, I cannot really try and dig in to see what happened with those videos. But I'm sure they have them videos. Everything is recorded, so nothing can be missed. Please, please, please send an email at webinars@hfm.com or our live chat on the website. You know the website. There is at the very bottom there is a live chat. If you text them, they will help you as soon as possible. Okay, thank you very much. So the vice versa scenario. What happens when the demand for Forex? What happens to the demand when interest rates decrease? So when interest rates decrease, investors can expect a lower rate of return, right, on their savings. You have seen what happened the last few years, right? So the higher the interest rates, the more the rate of return. The lower the interest rate, the lower the rate of return on savings, deposit, lending, or government and corporate bonds, and etc. So again, theoretically, investors may find it better elsewhere, right? So this means the demand for the currency will fall due to the fact that investment capital flows are diverted to a more attractive investment destination. This will depress the country's exchange rate. It will also increase the supply of the domestic currency in Forex markets and drive the price of the currency down further. A quick reminder over here. Now we'll put on my cable, while not cable. Remember that this is cable. Okay, can you see it? Yes, you can. So this is cable. Remember that in our currency, what is a currency pair? Currency pair, right? Is one currency against another, right? So here we have pound and US dollar. So it reflects the difference between two economies, the US economy and the UK economy. Remember that every currency, at the back of every currency pair, is the country, the economy of that country. So over here, what we see a comparison of UK economy and US economy. So let's get back to our slideshow. Here we are. This is, again, if we see interest rates decreasing, that leads to, sorry for that, that leads to reducing demand, right? And the quantity of currency traded decreases, and that's why the price of currency in terms of another currency depreciates as well. So, a very nice question. Wilbert is asking, which is better for the economy, high or low interest rates? neither high, neither low. The interest rate shouldn't be neither too high, neither too low. We want stability. That's why every single central bank has its own target. So, uh, for example, ECB is at 2% interest rate. Fed is at 2.5%, if I'm not mistaken, in the near term. So we want stability. Neither too high interest rates, as we said earlier. So we're gonna see everything in a bit. Actually, we're gonna see it in a bit on what is inflation. Too high interest rate costs have some both positive but negative consequences as well. But also too low interest rates have both positive and negative interest rates. We're gonna see everything in a bit. Now, let's move on to inflation. So I started with interest rates because, as I said, it's the tool to support and control the economy. So let's move on to what is inflation. So theoretically, inflation is the rate of increase in the cost of goods and services in an economy. Sorry, excuse me. So the adjustment to inflation impacts the spending power of consumer, right? Remember that the spending power of a consumer has a spiraling effect on business ability to produce goods due to the spike in the cost of raw materials. While on the flip side, when the price of goods and services decreases substantially and the value of the currency strengthens, this effect is referred to as deflation, which I'm going to explain in a bit exactly what it is and how it affects us. So the central bank, as we mentioned earlier, of each country is responsible for adjusting the level of inflation and uses the consumer price index to measure the rate. So think it as a basket. Actually, this is what it is. How the inflation is calculated is on the basis of weighted basket of the most commonly bought goods and services in the economy. Okay, and there is a track of their prices across time, usually on a monthly basis, and it gives us an indication of the rate of change in the cost of goods and services in our economy. Now, how does inflation affects exchange rates, right? So, as we mentioned earlier, it was the question from Centric. Okay. Yeah. So, yes, actually, Centric asked which is better for the economy, high or low interest rates. We're gonna come in a bit to that exactly, but let's see what happens when we have a high inflation and when we have a low inflation. Firstly, in order to explain also what is better in regards to the interest rates as well. So when inflation is high, right, what that means? It means that the goods and services became more expensive. Okay. So when inflation is high, this has a negative impact on the country's currency. So the value of the country's currency weakens. This is because, as I said, the goods and services become more expensive and it becomes less attractive for investors to do business. The inverse is also true. When there is a significant lowering of inflation, there tends to be more flow of money in a country. So the buying power of the currency becomes more valuable and the exchange rate strengthens. There are no questions so far in our YouTube channel. Okay, we move on. So let's merge now the concept of inflation and interest rates. Okay. So as I repeatedly stated so far, the central bank uses interest rates in order to control inflation. So the central bank raises interest rate to slow down economic activity as people have more money to spend, which is a contributing factor for higher inflation. While on the flip side, low inflation stimulates movement of money, while an increase in interest rates discourage people from spending. As I explained earlier, the higher the interest rate gets, the less money the people have for spending, because they have more to the goods and services, the groceries, all the expenses, the loans have become more expensive, and that detracts the spending. Let's move on. So this is exactly in a picture, exactly what I have just explained in a picture. So how does inflation work? How does inflation work? As you can see over here, inflation represents, as we said actually, the rate at which the cost of goods and services increase over a period of time. So when demand for goods and services exceeds production capacity, then we can see, right? We have an increase of the goods of the prices for the goods and services, and this is when we have the so-called demand pull effect. So demand pull inflation occurs when an increase in the supply of money and credit stimulates the overall demand for goods and services to increase more rapidly than the economy's production capacity. So this increases, guys, demand and lead to price rises. Okay, so people have very simple words. People have more money. It leads to positive consumer sentiment. This in return, leads to higher spending, which pulls prices higher. It creates a demand supply gap. As we say, with higher demand and less flexible supply, which results in a higher price. Now, oops, sorry. Here we are. Okay. Now, also, cost push effect. Sorry, cost push inflation is a result of the increase again in prices, but working through the production process inputs. So when additions to the supply of money and credit are channeled into a commodity or other asset markets, cost of all kinds will lead to a goods rise. Okay, so this is especially evident when there is a negative economic shock to the supply of key commodities such as oil, gas, copper, industrial commodities as well, or soft commodities, cotton, etc. So this development lead to higher costs for the finished product or service and work their way into rising consumer prices as well. So for example, when the money supply is expanded, it creates a speculative boom, let's say, in oil prices. So this means that the cost of energy can rise and contribute to rising consumer prices, which is reflected in various measures of inflation. I think the last 2 years we have seen exactly, precisely this cost push inflation. The rise of oil and gas led to rising consumer prices, and it was something that supported and boosted further inflation. So the last 2 years, actually, since after the pandemic, no, actually, yeah, the last 2 years, because precisely after the pandemic, we had the decline of oil. So since last year, we have literally seen this cost push effect. Last but not least, what we call built-in inflation, okay, which is the very last category of inflation, is the inflation that is related to adaptive expectations, or the idea that people expect current inflation rates to continue in the future. So all lead to higher prices, guys. Okay, I don't want to. It's just it's different factors that lead to higher higher prices of goods and services. Three different factors that could lead to higher cost of goods and services. So the last one is built-in inflation. As I said, built-in inflation is related to the expectations or the idea that people, market participants, everyone is that idea that people expect current inflation rates to continue in the future. So as the price, you can see in the illustration, as the price of goods and services rises, here we are, up, the wages, the salaries, okay, rises as well in order to maintain the living cost. Because if the since the prices of goods and services rises, people may expect a continuous rise in the future, right? So workers, everyone actually, all the employees may demand more cost or wages to maintain their standard of living. So their increased wages results in a higher cost of goods and services, and this wage price spiral continue as one of the factors induced the other, and vice versa. And here I have an old example, but you can clearly see the impact. Actually, let's start with you see how inflation is correlated with the average hourly earnings, the wages. So the lower the inflation, the lower the wages. The higher the inflation, the higher the wages, and so on and so forth. And on the previous slide, I have the personal savings in correlation with the inflation once again. So as you can see over here, so here is okay, so it's, as you can see, it's the diagram of around 20 years. Yeah, 20 years. So the higher the interest rates, right, the higher the savings, because as we said, it will mean higher rate of return from your saving account, from your deposit, from your if you have invested in government bonds, and so on and so forth. But the lower the inflation, the lower the personal consumption, because it's not that as attractive as an investment, and etc. So Now, so this is since today is all about US inflation as well. I have embedded in today's session also actually the top 5 facts on inflation, on US inflation more precisely. So inflation, inflation has been low in the US for decades. We had to take since the beginning of the US economy. Okay, so but a rebounding of economy of the US economy and a new burst of spending has raised some concerns about the prospect of rising prices. So here are 5 facts on inflation, on US inflation more precisely. So the very first one, the Federal Reserve defines inflation as the increase in the price of goods and services over time. So what that's supposed to mean? So, just a second too. So, sorry guys, where's my slides? Okay, here we are. So each month, guys, the Board of Labor Statistics released the consumer price index, the inflation indicator, the one that we're going to see today, which is the most widely used, as I said earlier, measure for inflation. Okay, so this number, the result of the inflation reading from the Board of Labor Statistics is taken by the Fed along with the personal consumption expenditure as well. So the Fed, the Federal Reserve, uses the inflation and the personal consumption expenditure, okay, in order to frame its future outlook. Okay, so increase in the prices of goods and services over time is what's the definition of officially from the Fed regarding inflation, and have in mind that the Fed is using these two readings, the personal consumption and the inflation figure, in order to decide any changes on its future outlook. Second fact, inflation can be caused by many factors, including too many dollars chasing too few goods. What do we mean by that? Inflation, as we explained earlier, can occur when there is too much aggregate demand in the economy, which is often a consequence of a strong economy and low unemployment. But there is also the belief by many analysts and economists that inflation can be caused by an increased government spending as well, and interest rates being too low for too long, which is something that can spur the issuance of too much debt and too much overinvestment. Third fact, the inflation rate of for the current inflation rate in the US is 3.2%. The higher that it has been the last few years is 7%, which is 2021. What happened in 2021? So even though, as you can see, the latest reading that we have seen was just last month, it's low related to the high one. It's 3.2%, which is like half of what it was in 2021. Even though the current inflation is relatively low, we can still see some goods such as mainly in the energy market or in the commodity market, that have seen their prices rise significantly the last year due to the acceleration of the economy. Fourth fact, interesting fact about inflation. The Federal Reserve used the federal funds rate to modulate inflation. So that was actually a result from an analysis made by the balance. So the Fed fund rates in the interest rate banks pay for overnight borrowing in the federal funds market. So the Federal Reserve uses it to influence other interest rates, such as credit cards, mortgages, and bank loans. It also affects the value of the US dollar, as we explained earlier, and other households and business assets. Historically, guys, you should know that the Fed has raised the federal funds rate to combat inflation. And a very, very good example for this action, let's say, it was back in the March in 1980, where the Fed funds rate increases as high as 20%. Last but not least, the Federal Reserve adopted an inflation target of 2.5% to 3% in the near term. That was the latest updated target that the Fed has actually right now for the near term, in the near term for inflation. So actually, after the global crisis, right after the global crisis in 2008, 4 years after, in 2012, the Fed, and like other central banks, adopted an inflation target, and the inflation target, it was at 2% for the Fed. And that was following the global financial crisis. Now they have amended slightly that target into 3%, with the near term, to 2.5%. So they have updated after the pandemic into the 2.5%, with the 3% to be the very, very near term target. So why the central banks are setting some targets? Because they believe, and why more precisely they have adopted this 2.5% targets, because they believe that 2.5% inflation in the long run will help them to meet this mandate most effectively. I mean, in order to the mandate, I mean to achieve maximum employment and stable prices. So here is just a graph with the inflation rates in the United States since 2013 up to date. You can see a huge spike after the pandemic. After 2020, so 2021 at 7%, 2022 at 6.5%, and is somewhere halfway so far this year. Now, Brian is asking, does inflation increase price of the importing country? Yes, it does. Okay, yes, it does. So, sorry for that. So, as you might heard over the years, or as long as you are like studying financial markets and etc., that we have different types of inflation. Okay, sorry for that. Different types of inflation. We have stagflation, hyperinflation, and deflation. Let's take it one by one to see what these different types of inflation are and what they mean for the economy of each country and for the global economy as such. So, first of all, let me double check what's going on in there. Hi, Jalal. Hi, Rifat. Welcome. You arrived a bit late, but don't worry about it because the video stays in our social media. I can see that Jalal joined via LinkedIn and Rifal from YouTube, so don't worry about it. It will stay in our account and you can watch it once again from the very beginning in order to understand and comprehend better the inflation, interest rates, and how it affects the market. So, stagflation, hyperinflation, and deflation. The three main types of inflation. Okay, let's start with stagflation. Stagflation is the economic condition where we see economic growth to be very slow or even stagnant sometimes. That's why it's called stagflation, while the prices are rising. So growth in a country, it's increasing, but very slow, or even it's steady, while the goods and services, etc., are rising. So this term, the term stagflation, it was coined by a British politician back in 1965. Okay, so when he mentioned that we now have the worst of both worlds, not just inflation on the one side or stagnation on the other. We have a sort of stagflation situation. So that word, if you prefer, was coined by a British politician. So it's exactly what he said. It's the worst of both worlds, right? So we have slowdown in an economy's growth, right? That's why I've seen GDP declining over here, right? Unemployment rising. So this is a side effect of stagflation. Economic growth declines, coupled with an increase in unemployment, right? Decline of demand, accompanied by a rise in prices, and as a consequence, inflation, right? So the worst from both words. This happened also during 1970s as well, at an international level, when the world oil prices rose dramatically, fueling sharp inflation in developed countries. So this also shows such a condition. It shows also a poor implementation of government policies. So the lack of central banks and government to control the whole situation. And there is a recession, obviously, in most of the economic activities, not only employment and in general growth. So hyperinflation. So it's the situation when we have a fast rising inflation, so the price increases are too sharp. Okay. So what's the difference between hyperinflation and inflation? Mainly the speed. Hyperinflation often when there is a large increase in the money supply, which is not supported by growth in the gross domestic product. So such situation, such as this one, results in an imbalance between supply and demand for the money. So, so it results, as I said, into a sharp increase in prices and so a fast rising inflation. So that has that is causing a depreciation on the of the currency. So what causes hyperinflation? Government rises, increase the amount of money into the economy. The money supply increases so that the purchasing power decreases. This excessive money into the economy contributes to rising inflation. With too much money in circulation, prices skyrocket. Now, last but not least is deflation. And I have a bit of a type over here, sorry for that. So deflation is the opposite of inflation. Deflation refers to the idea, to the situation actually, where there is a decline in general price levels. So deflation, as you can see from the diagram over here from the economicshelp.org, deflation occurs when, here we are, deflation occurs when the inflation rate falls below 0, okay, or even negative sometimes. So deflation has as a consequence the increase in real money, in real value of money, and allows to buy more goods with the same amount of money over time. So it can also occur. It can occur owing to reduction in the supply of money or credit. So it has also some side effects, which is mainly on the unemployment, so increase of unemployment in the economy. You can see that, because why this happened? Because the process often leads to a lower level of demand in the economy. That's why it has a consequence in the labor market. So recession, fiscal austerity, declining confidence, falling money supply are some of the causes that they could lead to deflation. And also another scenario is the lower oil prices, improved technology appreciation, or falling import prices, which can lead to lower cost of production, can also causes of deflation. Thank you, Nicole. Thank you for joining. What's the correlation between inflation and consumer price index? Consumer price index, it is the inflation, okay? Inflation is the weighted, let me get back to the initial slide because you might have been confused at this. So inflation as such is the rate of increase in the cost of goods and services. Okay, so it is the consumer price index, the same thing. Okay, it's a collective the consumer price index is a collective basket of the most commonly bought goods and services in the economy, whose price is tracked across time in a monthly basis, usually in a quarterly basis and yearly basis, to give us indication regarding any rise or fall or overall of the cost of goods and services in an economy. Okay, dear Emmanuel? Yeah, okay, let's move on. As we mentioned, the higher inflation weakens a currency's currency. Expensive goods detect investors, making it less attractive for businesses. Low inflation boosts money flows and increases buying power and strengthens the exchange rate. Let me just also show you. So, so let's merge the two concepts: inflation with exchange rates and inflation with interest rates. So here, higher inflation, right, prompts higher prompts interest rates hikes, and this has as a consequence. Actually, let's go straight to the example, maybe that. Okay, here we are. So remember that we said that high inflation, okay, tends to weaken the country's currency because goods are becoming more expensive and so on and so forth. So why inflation, though, causes interest rate highs? Remember that, as I mentioned, central banks raise interest rates to slow down economic activity because people have more money to spend, which is attributing factor to higher inflation. And low inflation stimulates movement of money, while an increase in interest rates discourage people for spending. So, however, I will get back once again to the question that Centric did regarding high or low interest rates. So at that point, here we have the balance of trade. Let's understand the balance of trade because it's key in order to see also how does the Forex market is affected by changes in the inflation and changes in the interest rates and so on and so forth. So balance of trade, guys, is the variance between a country's income due to exports and its expenditure due to imports. So balance of trade can further be broken down, let's say, into balance of trades for goods or for services. So when inflation drives the prices up within an economy, that nation becomes less competitive in the international marketplace. So this results in exporters losing ground to cheaper countries. That was also the question of Brian. Does import inflation increase price of the importing country? So, the higher the inflation, like the less competitive is that country in the international marketplace. So the less the ground of exporters to cheaper countries. This means that the balance of trade is altered and demand for the currency declines. So, okay, so again, that comes to the theory with high inflation, lower currency and that has already been explained by the balance of trade, as I mentioned earlier. So, sorry. That's why during times of high inflation, such as 2021, 2022, and etc., during the times of high inflation, the foreign goods and services became more attractive to consumers and businesses as they are cheaper. So that means, guys, that imports will increase. Consequently, this caused also an increase in the currency supply in the forex market, which results in a depreciation of the currency. Now, how to trade forex market considering a higher inflation or lower inflation, so on and so forth. I think we have covered everything, but now you need to think about how, sorry, how this appreciation or depreciation of the currency due to high or low inflation is illustrated, is presented into the forex market. So when you trade forex currency pairs, okay, remember that you will need to consider both currencies in an asset, both in a pair, and consider the economy behind each of those currencies. So remember that we said initially that is a comparison between two economies. So euro dollar represents the comparison between the European economy and the US economy, and so on and so forth. The same time from pound dollar, for dollar yen, and so on and so forth. So, because it's all about supply and demand, as we said, for that specific currency. So it's this fluctuation between supply and demand, supply side, which is the cost push that we saw earlier, and the demand side, inflation, which is also known as demand pull, that we saw earlier, affected by several factors in the market, such as labor, domestic supply and demand, energy market, and so on and so forth. So over here is just a historical decomposition of the core inflation in the US. And you can see how the oil, the supply chain disruption, the gas prices due to the Ukraine invasion, the solid labor market has led to a spike in the inflation. That's just for you to be aware of some of the latest factors, of the most recent factors that causes supply shock and led to higher inflation into the international market, not only into the US. Supply bottlenecks, energy, and so on and so forth after the pandemic. Now, over here we have some examples from some major pairs. I have over here dollar yen, dollar CAD, euro dollar. Euro dollar twice, but two different time frames. The first, the left hand side one, it was in the middle of August, and the right hand side one, it was at the end of August. So what that's actually, these screenshots are taken after the release of inflation figures out of the US, and you can see how it was at the time of the release, how the market reacted reacted, and how the perception, actually we could see the perception of the inflation reading into the Forex market. This is why I put this chart on. Also, how does the US inflation rate affect minor currency pairs such as euro, yen? Very, very well. Okay, I'll come in a bit. Okay, let me finish the major currencies first, and then we're gonna along with, because what's the time? How long is we have until the figures are out? We have plenty of time. We have an hour, more than an hour until the figures out. So before I move Precious, before I move to an overview of what's expected today and how it could affect the dollar crosses, I will also explain how it could affect minor currency pairs as well. And your example is very good because it's a yen currency. And remember that yen is considered to be a safe haven as well. So I will come to that in a bit. Okay. So, okay. So guys, here we are. I will bring my platform, and here is, let me just, so this is euro dollar in the 1 hour chart. And as you can see, ahead of the inflation, ahead of the inflation reading today, we can see the euro dollar rising. So this means weaken dollar, right? That led to the anticipation of the US inflation date, of the US inflation release, led to a depreciation of the US dollar. And if I zoom in further into the 30-minute chart, we can see a bit of a narrow range the last 2 hours mainly. But here we are. So on the anticipation of this important announcement today, we have seen since last night a rise and a retest of 108. So that means weaker dollar, stronger euro against the US dollar, but with 108 handle to be a key barrier of this performance. So what happened over here? What happened over here is that the market participants are a bit skeptical, let's say, so ahead of the major announcement next week. Okay, so sorry, not next week, actually tomorrow. Tomorrow we have the Fed as well. So even though US inflation is a crucial release, however, this week we have central banks rate statement and rate decision and statement. We have tomorrow Fed. We have on Thursday ECB and Bank of England as well. So there is some cautiousness ahead of Fed tomorrow, ahead of the major announcement from central banks, that it remains extremely murky, if you prefer. So that's why there is a bit of consolidation the last 2 hours. But what is expected for today, okay, is, let me just bring back the calendar as well. Here we are. Here we are. Just a second. Okay. So what is expected today from for the U.S. economy, for the U.S. inflation, is to see a lower headline, so yearly reading from 3.2% to 3.1%. The inflation excluding food and energy to stay steady at 4%. Okay, and I'm referring to the headline. While the monthly reading, so for November, to see a slight increase to a slight growth to 0.1%. This is what expected for today's inflation. So that presents a bit of a rise after a flat reading that we got on October. So much of the weakness seen overall should come from the projected contraction, 7% drop actually in gasoline, in inflation gasoline prices. So the decline that we have seen in the gasoline price expected to present an overall weakness. However, if data come in line with these expectations, okay, that will mean, guys, that there is some progress being made, and it has been sufficiently enough to get potentially the Fed to back off further hikes and move to the sidelines. So what I mean, if indeed we see inflation today slowing down a bit or even coming in line with expectation, this suggests stability in the US economy. It shows it's positive regarding to the inflation, to the US economy, to the aggressive action that the Fed has taken the last few years. So that will be a positive for the Fed and for controlling the inflation. Remember that I showed you earlier that it was as high as 7%. That's why expect a slowdown today will be good, will be what the Fed wants in order to stop increasing interest rates and to call it a day and remain sidelined and keep and actually pause the interest rates, the policy in general. Okay, so however, the key about today's reading is not whether whether it will see a missed or a bit of expectation and etc. Is the question is when will officials feel confident enough that inflation is on a sustainably downward trajectory to declare victory. So this is why today's reading is so important, because it will give us an indication regarding the timing of the Fed to say that we have achieved what we wanted, we managed to control inflation, and we'll keep rates unchanged for a while before we start cutting interest rate hikes. So it's all about the perception. So today is about the perception regarding inflation reading and the perception regarding the future policy, central bank policy for 2024. What this number mean for the Fed and what it could change or could not change in the outlook, in the central bank outlook. That's why we have seen in general, I put the daily chart on, okay, this is the daily chart on. For the last 1, 2, 3, 4, 5 days in a row, we have a bit of a steadiness, a bit of a sideways movements on the euro dollar. It's because there are mixed, it's a cautiousness, and there are mixed signals regarding the near future of the Fed and the US economy. In the near term, okay, we have seen that after the really strong jobs report on Friday, this which would lead to some aggressive easing, which would actually precede some aggressive easing bets, that held down a bit and wounded a bit. Okay, that's why we've seen this sideways movement, because actually the market participants don't remain cautious ahead of the inflation, remain cautious ahead of the FOMC tomorrow, and they just wait for another clue in order to help them to start speculating the very next step for the Fed. So we have left at the side the expectations for a pushback against rate cuts, but we have also left pending the expectation for further tightening, which is this is a clear indication that the market's waiting for another clue in order to confirm that the interest rate hikes are over. That's why we could say that for inflation day, that's a bit of a muted response of dollar. So decline in the US dollar weakening in the near term at key barrier against euro at 108 ahead of the reading in an hour. So a missed guys, a lower inflation number today theoretically suggests that Fed will be over with interest rate cuts, and that's why we might see the Fed fund futures betting for an increase, for a cut of interest rate hikes in the very first quarter of the year. So that means depreciation of the US dollar. Okay. On the flip side, if we see a surprise again to the upside, beating expectations, then this could, in the near term, in the very, very short term, to appreciate the US dollar ahead of the Fed tomorrow. Okay, is this clear? So I think that's pretty much it. Let me check whether there are any questions pending. Sorry. If you have, that's so we are nearly at the end of the session. If you have any questions, let me know. Let me check the chat. Okay, there are no questions in the social media as far as I have checked, and the only question pending it is from Precious regarding the euro dollar, so I will finish with that one. And this is the daily chart. Okay, guys, this is the daily chart in which we have seen a clear strengthening of the yen the whole November, while we have seen a rebound. This is euro yen. Okay, a reminder. This is the Precious asked me, how does the US inflation rate affect minor currency pairs such as euro yen? Okay, so I will zoom in. Okay, this is the 1 hour chart, euro yen, which we have seen. Let me just zoom further. I will put even the 30-minute chart. Okay, which we have seen initially climbing higher during the Asia session, and actually until actually in the European session as well. Flattened at 157 territory and started, and actually we've seen a pullback the last 2 hours. So at the beginning of the initially we have a climb at the start of the week, and at the start of today's session as well, failed to extend further higher, and we have some pullback the last 2 hours. So as such, my dear friend, as such, minor non-US currency pairs don't have an immediate correlation with the US inflation. However, if the reading today causes any change in the sentiment, risk on or risk off situation to the market, we will see the minor currencies also minor currency pairs also being affected, because as I said, they might find some support from safe haven demands and etc. So, for example, as the US inflation looms, we can see that the yen rebounds against every other currency. In this case, is euro. So as we move closer and closer to the US inflation release, we have seen some support of yen, some support of the yen against dollar, against euro. Let me just see that as well. Let me put the yes, you can see that. So there is a so it's like there is a cash flow away from actually a cash into the yen ahead of the release. As I say, we've seen that is gaining some ground, and that's why we have seen the yen that has been showing some sharp swings today, this week in general. What else? So there is not a significant connection. Actually, there's a major disconnection between the today's reading and the minor and the non-US pairs. But because you brought up the euro yen, with the yen being a safe haven asset as well, that's why we have seen the yen gaining some ground ahead of the US inflation. So yeah, so a strong inflation report today, okay, could temper the market expectations for rate hikes next year, while a soft inflation will provide support for the market stance and could force the Fed to reconsider the hawkish position. So in this case, if the inflation, you have a strong inflation today, okay, that could push dollar yen, could add could see a rebound of dollar yen, okay, while on the flip side, a soft inflation could put pressure on dollar yen, and as a consequence, we might see the same performance against yen related assets such as yen crosses such as euro yen. So that was pretty much it. If there are no further questions, I'm gonna call it a date. It's been too long. So yeah, let me get back to the slides. So yeah, guys, I can see that there are no further questions unless if I missed something, but yeah, we could see some market stability, Joseph, especially because, as I said, we have tomorrow the Fed. So if today's reading it gives some mixed signals, we might see a bit of consolidation until we'll get more clarity tomorrow on the press conference. Okay, so in regards to the market, for example, in euro dollar, 108 is a key resistance area for the asset, while on the flip side, a return below 107.70 could open the doors to week's bottom and the 107.30. And if that breaks as well, we might see the asset returning to the 7 to 9 of November's bottom. But as I said, because we are just a day ahead of the Fed meeting, which is also another focal point, we might see the market, depending on the results as well, but we might see markets consolidating if today's reading is gives some mixed signals. So let's wait and see. Remember, Friday we had a pretty solid report. So this is adding to the ongoing signs of the economy's resilience. Okay, and that's further cautiousness ahead of tomorrow's Fed meeting. Okay, guys, I'm gonna call it a day. Thank you very much for attending. Feedback is more than welcome. Please email us at webinars@hfm.com for a feedback. But anything you need, we are here to help. So use our email address or social media to contact us, and we'll try to help you with anything you need as soon as possible. Thank you very much. Have a great day ahead. And see you again tomorrow. Actually, Mihalis, my colleague and our HFM Market Analyst will present a session on how to trade the trend masterclass actually. So it's a webinar focused on how investors can identify trends using basic and advanced techniques. And on Thursday, we're gonna have a live session as well. So a live session for interest rates in 2024. So subscribe in our YouTube channel in order to get alert on every live session that we are hosting. Thank you very much. Have a great day ahead. Take care. Bye bye.